Howdy, everybody. Welcome to Liberty Call. Today is, what day is this? Wednesday, July 31st, 2024. Hope you're having a fantastical day out there in the interwebs. It's another sunny, hot day here in Colorado. We got fires to the north of us, which is not good. We've got probably 2 or 3 major wildfires which have sparked up in the last couple days. So say a few prayers for our friends here in Colorado. We could use it. It's been a pretty rainy summer, but it's been just dry and hot the last week or so. So we could use a little precipitation, which is on the way, hopefully, and we'll put out those fires. So, all right, looks like a better day in the markets. Certainly not on fire. Well, I guess depending upon your perspective. But we had the Fed meeting conclude today, and the Fed decided going to leave rates where they are. Shock. But the market reacted very positively to that. So, all right. Well, if it is your first time watching Liberty Call, if you in the brown shirt could do me a favor, if you could give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All righty. Let's get into today's numbers. Oh, my back is hurting. Let's see here. Dow Jones was up 0.24%, 99 points, closed at 4842. S&P 500 up 1.53%, 83 points, closed at 5519. NASDAQ up 2.63%, 451 points. Big jump for the NASDAQ. And again, it's, if we kind of talk about how, what's been going on the last few weeks, you see that the Dow was only up 0.25%. Yet the NASDAQ was up, over 2.5. So that inverse relationship is still, still working in the S&P 500, which is kind of like that middle porridge, not too hot, not too cold, is kind of in the middle of both of these. So, and NASDAQ closed at 17,598. VIX was down 7.52% today. It's at 1636. Canada up 1.25, Brazil up 1.08, and Mexico up 1.55. In Europe, Germany was up 0.48%, the UK up 1.13%, France up 0.76%, the Netherlands up 1.39%, Spain was down 1.23%, Italy down 0.43%, and Switzerland up 0.31%, and Portugal up 1.04%. Russian exchanges, both green again today. The MOEX flat up 0.02%, RTSI up 0.28%. And the overnight markets, the Nikkei in Japan was up 1.59, Australia up 1.75, New Zealand up 0.37. In China, the Shanghai was up 2.06, the Shenzhen Component up 3.37%, China A50 up 1.64, DJ Shanghai up 2.44, Hang Seng up 2.01, and the Taiwan weighted down 0.11 for today. All right. Good stuff. Like I said, markets were just freaking out, or I guess the financial journalists and those on Wall Street were just hoping and praying that the Fed would come through with some dovishness and lowering rates, but not today. All right, let's get to the market recap. U.S. stocks jump as Fed keeps rates steady but signals closing in on a first cut. U.S. stocks rose on Wednesday as the Federal Reserve left interest rates unchanged while signaling potential rate cuts in the near future. The decision boosted investor optimism, especially with many betting on a rate cut in September. The Federal Reserve acknowledged progress on inflation and cooling in the labor market, which fueled hopes for rate cuts. Fed Chair Jerome Powell noted that the economy is nearing a point where reducing policy rates may be appropriate, though decisions will depend on forthcoming data. Market futures are fully pricing in a 0.25 point easing in September, with a smaller chance of a 0.5% reduction and a 66 basis points of easing anticipated before Christmas. So basically, they're kind of hedging their bets. They're saying that between now and probably Thanksgiving, we'll have at least 50 basis points and maybe a third cut of another, for a total of 0.75% by the end of the year. So that's that 0.66 or that 66 basis points, I think, is kind of their hedge between what they think is either going to be 0.75% off from where we are today and 0.5%. So, either way, I know I've talked about this till I've been, purple in the face. Is that really going to make a huge difference in the grand scheme of things? I don't know. I mean, rates aren't that high. I mean, these are where rates were for, most of the 90s and, the early part of the 2000, probably the first 6-7 years before the economy took a crap. But what is pushing rates down to zero going to do again? I mean, all that's going to do is just build up pent up inflation that we've experienced over the last decade or more, plus all the money printing 4 summers ago, which had a dramatic effect on inflation. It was very quick. So I don't know if the Fed will go with the money printing again, other than just easing rates. That still creates inflation, but it's certainly not the massive explosion that we saw over the last 3 or 4 years. All right, tech and chip stocks. AMD surged 5% after posting better than expected Q2 results, driven by record data center revenue. UBS highlighted solid growth in data center GPU sales, particularly to major clients like Meta and Microsoft. Additionally, AMD sentiment was boosted by a surge in ASML holding ADR after reports suggested possible exclusions from U.S. bans on chip-making equipment in China to China. NVIDIA Corporation and Qualcomm also saw significant gains, jumping 13% and 5% respectively. Microsoft, however, fell 1% after its fourth quarter cloud revenue growth missed expectations, despite overall earnings just edging past estimates. All right, earnings reports. Meta Platforms, set to report quarterly results after the close, is expected to show a 20% rise in revenue. Starbucks stock rose nearly 4% as its quarterly profit met expectations despite global sales declines due to weak consumer spending in key markets. T-Mobile also rose 4%, raising its full-year forecast for monthly bill-paying phone subscriber additions thanks to its discontinued unlimited plans. Conversely, Pinterest fell 12% after offering a softer-than-expected Q3 outlook despite achieving a record 522 million global monthly active users. I don't think I've ever been to Pinterest. I mean, I might have gone to the website once or been taken there by Google, but I don't think I have an account, or I guess people use it still. Match Group soared 14% after beating Q2 revenue expectations and announcing plans to lay off 6% of its staff to cut costs. Overall, the combination of potential rate cuts and mixed but significant earnings reports shaped a positive outlook for U.S. stocks today. All right, so everyone's in good mood. The Fed didn't do what everyone's been hoping for, but everyone seems to still be in a jolly mood out there. All right, let's get into some data. U.S. pending home sales surged in June. Contracts to purchase previously owned homes. That's a nice way to say old or used. How come they're used cars, but they're pre-owned homes? That's just, I've seen some dealerships that refer, to their used lot as pre-owned sales. It's a nice way of saying you're buying a used car. Not that there's anything wrong with a used car, but I prefer to get them new. I know you pay more, you probably pay 10, 15% more versus getting like a lease or, buying something that's been leased for a year or something like that. But, I want my own farts in the seats, not somebody else's. So, all right. Contracts to, as we said, purchase previously owned homes in the U.S. rebounded sharply in June, driven by an improvement in the housing supply and a moderation in mortgage rates. According to the National Association of Realtors, the pending home sales index, which is based on signed contracts, surged 4.8% to 7.43. This increase was observed across all four regions of the country. Economists polled by Reuters had expected a 1.5% rebound. Despite this monthly increase, pending home sales were still down 2.6% compared to the same month last year. The NRA chief economist Lawrence Yun attributed the rise in contract signings to increased housing inventory. While mortgage rates have decreased after spiking in the spring and house price increases are slowing, a significant rebound in home sales is unlikely. A Conference Board survey indicated that the share of consumers planning to buy a house in the next 6 months dropped to its lowest level since February of 2013. Additionally, the Federal Housing Financing Agency reported that house prices increased by 5.7% year on year in May, marking the smallest gain in 10 months following a 6.5% rise in April. All right, so that's that. Next up, this comes from Zero Hedge. Hawkish, FOMC still waiting on greater confidence on disinflation. And this is just some tidbits from the Chairman Powell's news conference. Gosh, having a brain fart there. All right, since the last FOMC meeting on June 12th, gold has outperformed while the dollar and crude oil have lagged. Stocks and bonds have also increased in value. U.S. macroeconomic hard data has generally trended weaker, with a brief exception with a brief exception, prompting dovish shifts in rate cut expectations that are significantly higher since the last FOMC, pricing in more than Fed's anticipated 2 cuts this year. Market expectations for the latest FOMC meeting were low, with only a 2% chance of a rate cut implied by the market, down from 100% certainty at the beginning of the year. The focus was on the statement expected to reflect increased confidence in the disinflationary path and Fed Chair Jerome Powell's comments. Key headlines from the FOMC meeting include the decision to unanimously leave the benchmark rate unchanged at 5.25 to 5.5, the highest in over 2 decades. Oh my God. Is it really that high? The statement was adjusted to reflect that the committee is attentive to risks on both sides of its dual mandate, a shift from being highly attentive to inflation risk. The Fed reiterated that rate cuts are not expected until there is greater confidence that inflation is moving sustainably towards the 2% target, or 4% if they change the target, which they've been talking about in recent months. The Fed acknowledged, quote, some further progress towards its inflation goal, and noted that job gains have moderated, with the jobless rate moving up but remaining low. The statement highlighted that risks to achieving employment and inflation goals are becoming better balanced. Market reactions to the statement were mixed. Analysts noted that while the Fed did not indicate an imminent rate cut, there was a careful consideration in language suggesting the start of a pivot towards easing, although not as dovish as some had hoped. So, again, they sat around and ate s'mores and had snacks on the government dime for a few days. And then they decided, hey, we're just going to leave it the way it was. We could have had a conference call and decide this. So, all right. One last bit of news that, this administration in Washington is just hell-bent on giving away money that isn't theirs. And it just chaps my ass to no end that, the party or these people who say no one's above the law, I got to follow the law. And every time it gets kicked back by the courts or the Supreme Court, they just try and find another way of weaseling around. And all this is these are bribes. This is not for the common good of the republic, as people like to say. They like to use the general welfare clause, for any little thing that they can do. Which the general welfare is the general welfare of the republic between the states, or the union between the states. It has nothing to do with things like healthcare or individual problems. I mean, this is ridiculous. So this article is titled, Biden Announces New Rules to Make Millions More Eligible for Student Debt Relief. This was authored by Jacob Berg via the Epoch Times. All right. President Joe Biden announced new rules on July 31st, making millions of borrowers eligible for student loan debt relief. Did he really announce it, or did it come out in a statement? Because I can't imagine that guy can put together 5 sentences that make sense. The administration aims to cancel student debt for approximately 30 million Americans. How nice. Addressing the burden of student loans and aiming to fix the broken student loan system. Now, have they stopped the current student loan system that is such a problem? The answer is no. There's still people, college, the fall session's getting ready to start here in probably, a month at least. So, I'm sure there's still students that are piling on debt through these same loans, and they're going to complain in 5 or 10 years that they got a degree in didn't even get a degree. They spent money on an education that didn't provide a return on investment that would allow them to pay this off in a short period of time. So, not my problem, really. The way I see it is, if you go out and get a loan on a car and it's a huge waste of money, that's your problem. I'm sorry if you can't sell it for what you owe on it. That, again, it's kind of like buying a house. You overpay, like these idiots did back in 2000s, in the early, or the 2004 through 2008, before, in that time where you had all the easy lending and, people borrowed, money for, especially out in like the Las Vegas area. That was the worst, where, home prices were going up like 20% a year. And, so just over a couple of years, what was a $200,000 house was now a $500,000 house. So if you bought, a property that was massively overvalued because of the way they could strain the real estate market there, if then the economy tanks, or the real estate value goes down, and you're sitting on a $500,000 mortgage and the house is only, fair market value is only $300,000, that's your problem. I'm sorry. That's just the way life works. All right. Starting August 1st, the Education Department will notify all borrowers with at least one outstanding federal student loan about potential debt relief and the August 30th deadline to opt out if they are not interested. So everyone's in the program. You have to opt out if you actually want to make good on your obligations. The eligibility will be determined based on the finalized rules this fall, potentially increasing the number of eligible borrowers to over 30 million, including nearly 4.8 million already approved for 168 billion in relief. Education Department Secretary Miguel Cardona emphasized the significance of these steps in aiding borrowers burdened by student loan interest and those financially worse off due to college. Again, they probably shouldn't have gone to college in the first place, and they should probably go get a real job and pay off their obligations and learn a valuable lesson. The administration's draft rules released in April aim to extend relief to millions of borrowers nationwide, especially those with growing balances due to interest, those in repayment for over 20 years, and those eligible for loan forgiveness, but yet to apply. If approved, the proposed rules would automatically apply relief to eligible borrowers. Those who prefer to opt out can contact their servicer by August 30th, which will not be able to re-enter the program. But will not be able to re-enter the program. Currently, the Biden-Harris administration has approved significant relief, $69.2 billion for 946,000 borrowers through the public service loan forgiveness fixes. I imagine that's probably where you go get a loan with the federal government, or I'm sorry, you go get employment with the federal government, and after you work there for usually like 10 years, they just waive your balance. I have a problem with that. Again, the federal government is not, that's not part of your. You work for us. You should not be doing that. Now, if a state or a local municipality and their voters agree, hey, we need teachers, we need whatever, cops or whatever, whatever it might be, if, to incentivize someone, say, hey, you come here, you live in our community, you work in our community for a decade. We as the citizens of this local area will pay off your debt. I mean, I have no problem with that. I mean, if that's what people agree to, fine, but don't do it on a federal level. I mean, the votes are too diluted, and you got too many thieves in Washington who will do anything just for a vote. So I'm sorry, it really angers me that we're $35 trillion in debt. I mean, per taxpayer, it's well over 200,000. I mean, I guess if we were to remove all federal employees from the voting rolls and all people who don't pay taxes, and so it's only taxpayers making these decisions. Okay, but unfortunately, the people who vote for this stuff are usually not taxpayers. All right, where was I? 51 billion for over 1 million borrowers through the income-driven repayment adjustments, and 28.7 billion for more than 1.6 million borrowers affected by school closures or court settlements. Additionally, 14.1 billion was granted to over 548,000 borrowers with total and permanent disabilities, and 5.5 billion to 414,000 borrowers through the SAVE plan. Biden reiterated his commitment to making higher education affordable and ensuring it serves a pathway to the middle class and not a barrier to opportunity. This makes education more expensive because you give loans to anyone who can fog a mirror, and that just put, the more people in college pushes the price up. And, now an alternative, if you want to go after all of the endowments, Yale, Harvard, I mean, even like University of Texas has a gigantic if you want to go after the endowments and drain those dry to pay off all the student loans, I don't care. I didn't go to college. It doesn't matter to me. I don't belong to any of these schools. I don't pay to any of their alumni funds. So do what you will. The schools are the ones who got rich off of this. It wasn't me. I get nothing out of, these idiots going to college for, bird calls and basket weaving. So the fact that I'm expected to pay it off is a real issue for me. So anyways, all right. Well, that's everything that I had in 5 minutes on my soapbox. So, all right. Well, if anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. See it right here on the screen. See it. All right. Well, I hope everyone has a wonderful evening out there, and I shall be back with you next time. If you're still here watching this video at this moment, give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. Talk to everyone next time. Adios.